Hi, everybody. It's Kimberly Banks Fawcett, and this is the July 2019 Note Closers Group meetup. Really happy to have you here and very excited about our speaker tonight. We have Nate Roberts, who is my accountant. We've worked with him for a few years now, and not only is he very smart and knows his stuff and can actually explain things to you, because as you all know, I'm very much into the yeah. Those are the rules. What do I have to do now? Kind of things. And he tolerates that, which is good. And as I mentioned in my Facebook post, he actually has a sense of humor too. So you will enjoy that. And he's previewed his presentation for me, and I think you're really going to love it. So with that said, Mr. Roberts, please take it away.
All right. Well, first off, Kimberly, I want to thank you for inviting me to talk here. I've enjoyed all this time where I always enjoy it when clients want to understand how things are working and they ask me questions, because when they ask me the questions, I have to start thinking, am I doing this the best way possible? And are there things I'm missing? So that's one of the things that's really enjoyable about working with you and a couple other of my note investing clients is the details we get into and the things that we break down help me think through what else do we want to do? Is there something we can do better? Is there a way we can plan this thing out better? From a tax standpoint, I typically tend to deal in the tax world. Just for a little background on myself and our company, Lifetime Tax Advisors, we have six full-time people, or we have 6 people that are on staff. We're also part of a developing family office. We have a wealth management division. We have an insurance division in addition to our tax, and we have outside legal that works with us. So we have several different offerings that we've got, and overall we've got about 13 people, give or take, on any given day. So when I was first asked to talk about bookkeeping, I was thinking, I do taxes. This isn't my favorite thing to talk about. But then I started thinking about, well, what are the advantages? Why would we want to do this? So if y'all will go with me here, just walk with me and humor me for a minute. Let me take you to the typical accounting firm's February and March. Client shows up and they've got a set of books and they're wanting a tax return. You open it up and, I've got to figure out how to take all this information and put it into a specific form to use it on a legal document. Sometimes it's very easy. Sometimes it's not as much. So let's take this year, for example. I had some clients who March comes around and I'm looking at it and their records aren't up to date. They're wanting a tax return by March 15th. March 14th at about 2:30 in the morning, I'm still trying to work through all the information, and man, I'm so tired. I'm having trouble just trying to put it all together, and they're not sure what's going on. I'm shooting off emails. They're trying to respond. They're tired. I'm tired. Everybody's trying to work through this, and that's really where this having good books and records becomes important. It's a whole lot easier to be able to just keep it up along the way instead of trying to put it all together when you're under pressure. So with that, is my screen over here being shared yet?
Nope, not yet. We just see you.
Okay. So that's kind of that'll hopefully help introduce where I'm coming from. I deal with this frequently, and just to help everybody along the way, this is a way to make your life easier and my life easier, and there's a lot of benefits too. So the more I thought about it, the more I realized how near and dear this is to me, and I'd like to help people understand a little bit more about what goes into it, why it's important, because it is something that a lot of times gets overlooked. So I am ready. Do I have to do anything to get the slides up?
You got to click the little green share button down at the bottom.
Okay, I thought I did. Is it showing now?
Nope, just you.
Just me. Okay. Screen share button. Screen 2. Oh,
hang
his
on.
share file.
Yep, there we go.
Okay. All right, so just my typical disclosure. This is for educational purposes. Please don't quote me. This is not going to be an all-inclusive presentation, but hopefully it'll kind of give you a little bit of a flavor about where we're going. If you need particular advice, I'd recommend you talk to a lawyer, you talk to a tax advisor. If you're looking for something like that, I will give you my contact information at the end, and you can contact our practice manager, and she'll help get you in contact with one of my staff. So after we just kind of covered what does January, February, March start to look like, this is one of the reasons that books and records are important is because of taxes. I actually only put that about halfway down, but on a daily basis, it helps from a lot of other aspects. One of which is tracking profitability. So a lot of times you want to know how things are going, but unless you have books and records that are up to date, it's kind of hard to know, am I really achieving what I want to achieve? The more accurate and more up to date they are, the more you can get some real-time analysis. It also helps you keep track of what do you have, what do you owe, and when you come down to doing taxes or taking something to the bank and they're looking for books and records, if my life's easier or if the bank sees books and records that they trust, you have the opportunity to potentially lower some of those costs, in addition to things like making it easier to do due diligence. And even if you have other things going on like audits, if I've got an IRS agent who shows up and I've got a good clean set of books, typically it just tends to make that a whole lot easier. There's other audits as well, and those things are other reasons why these are important. This is just a sampling of a few things that make good books and records helpful, but I hope that kind of gives you a little bit more about why this is such a great area to make sure you've got clean. Okay, so setting up the books. There's some initial considerations we probably want to look at. First one is, who's going to maintain the books and records? Is it something you want to keep up with, or is this something that you should request additional help with? If you're pretty comfortable with it, maybe you can keep up with it. If it's an area that's new to you, then maybe you want to grab some outside help. I know that we've got people on staff that help out with people setting up and maintaining their books. I know there's outside bookkeepers that do it. From my perspective, I'm happy as long as somebody's got a set of books. If somebody else is keeping them, I just want to be able to see how they're going along and review throughout the year, just to make sure that if something new is coming up, how do we help out? Is there something that we see that, maybe if right now we're in the middle of July, we're halfway through the year. If I know in July something's coming up, I've got 6 months to help a client plan through. This may cost you more in the future if we just keep going down this path, but maybe there's some planning we can do that helps to reduce the amount that you're going to be paying Uncle Sam. We enjoy taking the money that would be going to Uncle Sam and putting it back into your pocket. And I think most people tend to like that as well. Another thing to think about is who needs the information. Banks a lot of times want it. If you have partners, they're going to want it. Tax preparers. There are different people who have a stake in the company, and so you have to just kind of think about who needs this information, and those are a couple ideas. Another thing to think about is, what do you want or need to track? Sometimes things are pretty small. You don't want to get down into too much detail, but sometimes you want to have things broken out because, let's say for example, meals and entertainment. Meals are 50% deductible, and there are other things that are 100% deductible. So having those broken out and not having to go back and figure it out 6 months, 9 months, a year and a half down the road tends to be a whole lot easier. It's a lot easier if you're keeping it up to date as you're going along because, oh yeah, I remember this now. In a year, I've forgotten what happened way back when. And also, as I'm getting bigger, is this something that can grow with me? So the next piece that I want to just highlight is just coming from a tax firm. This is what our typical tax firm year looks like. Beginning of the year in January, things are a little bit slower. We're still trying to get a little planning done. Hopefully get everybody's books and everything up to speed. But then for about 3.5 months, our hours go through the roof. Go back to my first example. When it's 2:30 in the morning, I really don't want to be cleaning up somebody's books. I'd rather go home. I'd rather get some sleep. But I also want to make sure that I'm doing the best I can for a client. But if I'm doing that throughout the year, and let's say if I'm going into that dip right now in July, and I can help somebody start figuring out, here's where we're at, maybe there's just some things we want to look at, and we've got about 6 months to figure it out, tends to reduce the pressure and just tends to get happier people. So when you're setting up the books, here are some additional considerations I think you probably would want to take into account. Accounting systems, pick whichever one you like the best. QuickBooks, Xero, Resman, these are tools. They're great at helping us get a starting place and know that hopefully the information is accurate. But the information coming out is only as good as the information going in. So I think I kind of like the old saying, garbage in, garbage out. The better it goes in there, the better it's planned, the better it's set up, the easier it is for everybody to use it and the happier everybody is with it. Also, different users have different needs. So somebody who is just using this to track their own investments may have needs that are different from somebody who has a syndication, lots of different partners, they're reporting monthly or quarterly, and maybe there's a bank that's loaning money and the bank wants some information, the partners want something different. All these may be considerations, and it may be something that evolves as you grow. Also, how easy is it to make changes? Is it the old? Does anybody remember what DOS looked like, or the old Windows 3.1? Nowadays, we've got all these nice internet interfaces, which tend to be a whole lot easier. But accounting systems sometimes are a little behind the times. So is it something that's easy for you to keep up with? And what meets one person's needs may not meet another's needs. And finally, kind of going back to something I'd mentioned earlier, is it worth spending the time to track it? If it's $5, do you want to spend 15 minutes, 30 minutes tracking $5? Is the trade-off of the cost and the benefit really going to be worthwhile? I know that's coming from an accountant, so typically every accountant wants to trace everything down to the final penny. But from a realistic standpoint, at some point your time is worth more than trying to track it down to the last cent. So let me kind of give everybody a quick setting up the books. And actually, you know what? Let me stop for 1 second. Kimberly, if there are questions, is there something that I'm gonna see or anything where people can kind of raise their hand and say, hey, can you stop and help me out with that for a second?
Well, there's the chat button, which was right next to share. And no one's really asked anything yet. So, but I'll keep an eye on that and interrupt you if some hot button issue comes up.
That'd be perfect. I'm more used to live audiences, and it's a little harder for me because I don't get all the feedback off of this, so I'm just trying to see if there's something where I need to stop, or if the more that I know that people are following with me. I love it when I'm in front of a group and I'm getting head nods or I'm getting questions, because then I know that they're with me and what I'm discussing is getting across. So let's go up to just what are the basic elements of financial records. First one's going to be a balance sheet. some of you have seen these. A balance sheet from the highest level is really just a snapshot. It's a point in time. It tells you if I were to pick January 1st of 2019, this is the cash I have in the bank. This is what I owe. This is net what's out there. If I were to pick a different point in time, that balance sheet's going to change, and I can see the progression over time. But the balance sheet just tells me what do I really have today, or what do I have at the end of last year? What do I have at 2 years ago on any particular point in time? The next one is an income statement. Also, a lot of people also refer to this as a P&L, profit and loss, and this is something that covers a period, whether it's 1 day, 1 month, a year, and this is all of your revenues and expenses. The balance sheet and the income statement really tie together in this nice big circle. Money comes in, money goes out, and it's going to fall into one of these buckets. Assets, liabilities, equity is going to go on either the balance sheet, or it's going to come in as revenue or expenses, or go out as expenses. So these are probably two of the things that I focus on a lot. In addition, probably my favorite one is the statement of cash flows. It tells me how much money is coming in from operations, how much money is coming in or going out from investing, how much money is coming in or going out from financing. So a balance sheet's great, an income statement's great, but I think the cash flows are the most useful because it really tells me where's my cash coming from and how can I redeploy things? Where may I be able to get some more money from? And it helps me track to see, okay, this is a place where maybe I want to watch this because this area is taking down my cash flow, and cash helps you just take advantage of opportunities that exist, because if you got cash and somebody else doesn't, having the cash in hand, you can negotiate a much better deal. If you don't have the cash, suddenly if you need the money at the time, you've got to go and find somebody else. You got to go through all the work to maybe obtain financing or get investors. And so knowing where you're at and where the money's coming from just makes that a lot easier and puts you ahead of the game. And the fourth kind of base element is a statement of owners or shareholders or partners' equity. This really just tells you money that's come in, money that you've earned, money that you put in, money that you've earned, and money that you're able to take out of the business.
All right, we have a quick question, and I'm not sure it fits in right in this spot, so you decide when you want to answer it. But we had a question about how would you recommend people value their notes, especially a non-performing note? We don't necessarily pay for them based on the unpaid balance, so how would that work? If that comes up better later in the presentation, feel free to put a pin in it.
Well, actually, that may be good. Let me see if it hits this next slide. Okay, so the question, let me go back and repeat the question, make sure I understood it correctly. What's the best way to record the non-performing notes?
Yes, on your balance sheet.
On the balance sheet?
Yes.
Okay, so this is going to be very high level, and for each person's situation, you may have different needs. But here's one way that I would think about it. If I have a non-performing note, usually what are the things that I want to know? How much money did I put into it? What's it currently worth? And just kind of making sure I have a way to track it. So on a non-performing note, I probably almost want to create a couple different buckets. So that would be on the balance sheet. In the assets, you got the cash, notes, in this case, non-performing notes. Let's go with, maybe I've got a $100,000 note that I purchased for, pick a number for me, 20,000?
Oh, no, we can't buy at those
50?
prices. Just say 50 for.
Okay, you can't buy, okay. So 50 cents on the dollar?
Yep.
Okay. So let's say if I've got a $100,000 non-performing note. I bought it for $50,000. The easiest way probably to start is to think, okay, I've got cash that goes out the door. So if I put $50,000 into the note, easiest thing is I record $50,000 in cash and I put the note on my balance sheet for $50,000. It's a very simple entry, but it helps me know where I started. And then once we start going into that, and we'll kind of hit more specifics on the notes here later in the presentation, there might be additional costs that we want to track, and where you put them, how you clear them out. I mean, sometimes you might want to track some things differently for tax purposes, and another one for financial purposes. Like, yeah, I bought it for $50,000, but now I know more about the person that I've got the note on, and I've brought the value up to $70,000. So where do I record that $20,000 gain? Maybe you put it in your QuickBooks, maybe you track it separately, maybe you just create a new subcategory. There's different ways to track that, but again, that will come back down to what do I need the information for? Who am I using it for? Do I want something that's easy to break apart, or do I just want to have a separate schedule that isn't necessarily within my QuickBooks or my Xero or my Resman or whatever program I'm using?
Mm-hmm.
Hopefully that may give you one way to think about it.
But how does maybe we should look at it from the outside in. How would the IRS value that note?
The IRS is going to look at there's a tax term called basis. So the IRS is going to want to know, what's my basis? How much money did I put into it? Because they're going to say, if I put $50,000 into it and I sell it and it's worth $70,000, I sell it for $70,000, they're going to want to know that I made $20,000. So the way that they would see that is, if you keep that, that's one of the reasons why I'm going to default more to a tax presentation, just because there are so many scenarios. I can't even begin to cover them all in a week or 2 weeks. So just to give you a little more background.
Talking about this.
Yeah, no, I'd prefer not to be on camera for a week. But so when I went to school, I took to go get my CPA license. I had to have 150 hours at school, of which 30 semester hours had to be in accounting. So the things that I'm trying to explain here in 30, 45 minutes or so are things that took me years to even just learn the correct way to begin with. And then over the past, let's see here, 16, 17, 18 years, I've had to figure out how to correct them when they're not as clean. So yeah, I'd love to be able to get everybody up to speed in 30 minutes. But if I can do it that well, then either the accounting schools are doing it all wrong because it only takes 30 minutes and it's really easy, or there's a little bit more that I'm probably not going to be able to help everybody get on board with here this quickly. But hopefully the overview will make this easier for everybody.
Okay.
So yeah, getting back to your original question, what's the IRS going to want to know? They're going to know, well, how much did I pay for it, and did I make money or not? So if it's a $100,000 note and I bought it at 50, they're going to know that you bought it at 50, and then when I turn around and sell it, I want to take it off and I want to reflect a gain of $20,000 total. $70,000 in revenue, $50,000 of cost went into it, plus whatever other holding costs and other things may be in there, which gets me to my net gain. So that takes it from my balance sheet over to my income statement.
Okay. Does it matter if it falls in 2 tax years? Say I buy it in 2018, but then I don't sell it till 2019. So I don't realize it's worth 70 until the next year?
No, that's perfectly within what an accounting system is supposed to help you do.
Okay.
So that if you bought it in, so let's just divide 18 and 19. If I bought the note in 18 and it's sitting on my balance sheet in 18, when I get to 19, if it still hasn't been sold, it's still sitting there in my balance sheet. When I turn around and sell it, it moves from, let me go back to my previous slide here. In 19, it moves from my balance sheet down to my income statement. So I take it out of my assets and I move it over to my income statement, and then I make my money off of it.
Okay. So does your answer change if, when we're talking about a non-performing note, we actually get them to reperform?
Do you, at that point, if they're performing, I still own the note, correct?
True, but isn't it worth more now that they're actually paying on it? How do we adjust for that?
Well, and that goes that. So the question being, if they're paying more on it now, isn't it worth more? And that's where I was getting into all those different buckets.
Mm-hmm.
From a tax standpoint, I just want to track what money I put into it, so I'm not picking up way too much gain. From a fair market value standpoint, let's just say you're trying to go to a bank and you want them to understand that this $50,000 note is now worth $70,000. There's different ways to do it, but you may want to leave yourself some room to show how you got where all that came from. So if I have let's just say my initial cost as one bucket, but then I adjust it to a fair market value, you're adjusting the books differently. So I'm bumping up that value by $20,000, and then I have to have some other place that I'm holding it, but if I haven't actually realized it, then I've got, and this is going to get into some minutia, so I'll try and keep this very high level. I've got this nice unrealized gain. That means that at some point I'm going to trigger some tax because I've made $20,000 bucks. But I like the fact that it's unrealized right now, because that means until I take it from its worth $70,000 to I sold it for $70,000, I'm not getting taxed on it. I know it's worth more, and maybe I want my investors to know that. Maybe I want the banks to know that. Maybe there are other considerations where it helps me to track how quickly do I take it from being worth $50,000 to $70,000, and I can figure out my return on my investment. But sometimes you may want to have different places where you're keeping track of these things, so it's easier to back it out for tax versus financial presentation to my partners or financial presentation to the banks.
Okay.
So in some ways, I hate to use the word multiple sets of books, but that's kind of where we're going. Okay. And so when I'm trying to help somebody set these things up, a lot of times I may set up here's the tax basis in it. Here are my initial costs. Here are some of my holding costs, and then here's my fair market value adjustment to help me get there. That's just my personal preference. Different people have different ways of doing it. The main thing is, can you get the information quickly and efficiently without having to go back through and recreate, well, what was I thinking at the time when I did this?
So if in your books, you're recording an unrealized gain so that you can show actual value to a partner or to a bank to get a loan, you can still not record that for tax purposes? The IRS doesn't get upset by unrealized gains?
No. So let's go to a very simple scenario that a lot of people will probably be familiar with. If I go and buy, how many people have heard of Amazon.com?
Probably a couple of us.
I wish I could see a raise of hands, but I'll just go with the person I've got. Kimberly, have you heard of Amazon?
From time to time, they show up on my front doorstep. So yeah, I've heard of them.
Okay, mine too. Back in, 1999, 2000, had I been smart enough to buy Amazon at about $3 a share, right now it's worth somewhere around $1,900 to $2,000 a share. But if I bought it back in 2000 or 2001, whenever it was down in that price range, and I've held it until now, its value has increased, but I haven't realized that. It's almost a phantom gain because I don't have the cash in hand from selling it. So the IRS doesn't tax me on the increase in the value of my shares of Amazon today, because if I were smart enough to have bought Amazon at $3 a share back then, right now I would be sitting on a beach in the Cayman Islands with my Mai Tai and be trying to explain books. But since I didn't, I get to explain this. Okay. My gain is $1,900 minus $3. So let's just say if it's roughly $1,900. I've got an unrealized gain of $1,900. The IRS isn't going to tax me on it, because then I suddenly have to be able to come up with cash that I don't have, and that value goes all over the place. So it's the same thing with a note. You don't get taxed on it until you have some sort of event where you realize income. Now, in the simplest scenario, Amazon, I bought it at $3. Let's say tomorrow I sell it for $19,003. My revenue is $19,003. My cost was $3. I've got a $1,900 gain, and I'm going to get taxed on it. But I've held it for 19 years, and I didn't realize that until July 11th, 2019. So that's really what's going on with the note. I bought it, whether I bought it last year, whether I bought it last week, whether I bought it 10 years ago. There may be some income coming in off of it. So let's say I'm starting to get some interest income. Then there's a little bit of interest income, but I'm not going to generate the full gain on that until I turn around and sell the note. And there's a lot of things I don't want to unpack about that right now. But to keep it short and sweet and to the point, the IRS realizes that those things have different values, and until it's sold, we're not going to get taxed on it. We're not going to get taxed on that aspect.
Okay. Have you ever had that come up in an audit and had to argue over that? Not necessarily about a note, but about an unrealized gain?
No, I can't really think of. So what's funny is, if you ask me about an audit, where do I usually run into my problems? It's the books and people not keeping the records and then trying to argue about what happened. Sometimes it's because people start messing with equity. So let me give you a couple examples. I had one client who had somebody preparing some returns. 2014 and 2015 were prepared by somebody else, and we picked up their books in 2016. The IRS contacted them about 2015, and between 2014 and 2015, there was about $100,000 discrepancy that the IRS was trying to figure out what happened. Did more money come in? Was it income that was missed? And it turned out that the prior preparer couldn't figure out where it came from, just plugged it into equity, and the IRS, that's exactly where they went and looked. They said, you know what, there's this $100,000 that you didn't report, and we're going to go back and we're going to add it to your income, and here's the tax plus the interest plus the penalties, and it's not exactly the most fun experience. This is one of the reasons why I point out that these things are important. Another client had money going into and out of the business. Some of it was business related, some of it was personally related, and that's more where I tend to get into a lot of these discussions with an auditor, is how things are recorded, because if they're recorded correctly, they don't tend to push back unless they think that there is something that's just recorded wrong. But usually it almost diffuses the situation a lot if somebody already has books and records that the IRS doesn't have to go through and question. Sometimes somebody may not have books and records, and so the IRS is trying to recreate it, and they're just going to go off somebody's bank statements because that's the best information that's available. So it's always nice to have the tool of your books and records in your back pocket, because suddenly, here's where I got my information from, and you can kind of narrow the focus so that you don't get somebody who's digging and thinking that there's a whole lot more money, and then you spend a lot of time going back and forth with the IRS.
And I think this brings up a point that you've stressed with me a number of times. Obviously, in the end, it matters how you put it together, but if you're consistent with how you do all of them, it's a much easier conversation if they ever had a question. As long as you're consistent,
Oh, yeah.
things go better in an audit.
Yeah.
Okay.
Yeah. If you're consistent, then I can be consistently wrong, but at least I'm consistent and they know what they're looking for. And if they kind of narrow it down to, oh, I think it's just this one little area, it clears about 90% of the stuff off the plate. And I'm just arguing over one little area. And I tend to be able to get them out the door a lot faster.
Okay.
So when I've got somebody who's got books and the IRS wants an audit, usually I'm thinking, okay, I'm a step ahead of the game. When somebody doesn't have the books, I'm usually talking to my client about, we need to get something in place to keep them from just wanting to recreate what happened over the course of a year, because that's going to get long and expensive, and nobody wins in an audit.
Right.
So it's always good to have the support and everything up front so that you're not fighting over it.
Okay. Now we have sort of two follow-up questions. Do you want them now, or do you want to go a little further in your presentation?
Let me try and get through a couple more things just so that we keep this moving, and then
sure,
I'll grab a couple more questions. If you think that it fits in a good spot, go ahead and please interrupt me.
Okay.
I like the back and forth, but if we're not there yet, maybe we'll table those until we get to the very end.
Okay.
Does that sound like a plan?
Okay.
All right. So where does it go? Talk about assets, liabilities, equity. And then on the other side, the income statement, you've got your revenue, things like interest income, rent, other fees that you may bring in, expenses like bank charges, dues and subscriptions, repairs, advertising. So this is, again, a very high level, oversimplified example, but just kind of gives you some ideas of what's going on. And when you take your revenue and your expenses, your revenue minus your expenses tells you if you're making money or losing money. So, and this is a question I get all the time. When I'm sending my books, hey, I spent money, isn't it always an expense? Not exactly. So again, this is going to be from a tax standpoint. There are other methods of accounting, but when I'm dealing with the IRS, and let's just go with the highest level, broadest way I can paint this picture. There are amounts that I have to capitalize. One of these would be holding costs. So if I get a non-performing note, I paid $50,000 to buy the note, but maybe I also have to, so one of those costs, these are the amounts that are paid to acquire, produce, restore, or improve the property. So my purchase price may be $50,000, plus maybe I had to pay $500 to get the title shifted over to my company's name. Maybe I pay somebody a commission or an acquisition fee. Maybe I'm paying costs to maintain the ownership. The IRS defines what things need to be capitalized. And then on the other side, you have expenses. And the great thing about this is they don't define expenses very well. They just say these are essentially amounts that don't have to be capitalized. So there is gray in here, but let's just keep it a little simpler. Utilities, small repairs, insurance, cleaning, these are some things that aren't necessarily amounts that you're paying to acquire, produce, restore, or improve the property. These are just ongoing costs that really don't generate much of a future benefit. But this is also tax. So for what I'm talking about is tax. And for every rule, there's an exception, and there's an exception to the exception, and there's an exception to the exception to the exception, and the list goes on and on. And people have been fighting about this stuff since the tax code came out in 1912, I think it is. So, but that also gives you a lot of case law and a lot of things to look at where people have tried to slice and dice this stuff, and it kind of gives some pretty good pathways to go down. So you have to be able to take them, and when you come to the fork in the road, you just have to figure out which one you're going to take. So just because I spent money doesn't make it an expense. It may just be an expenditure, and maybe I get my benefit now. Maybe I get my benefit in a couple of years when I turn around and sell the note. So if I bought that note in 2018, I turned around and sold it in 2019. If I capitalized it in 2018 and I hold it and I hold it and I hold it, and in 2019 I sell it, that's when it releases that expenditure, and I get to use the benefit of that money going out at that point. And then here, this is just going to be a very simple way to help people think about capitalizing versus repair. So typically, it's an amount paid for an improvement or restoration, or it's a betterment. It expands, it makes something more efficient, improves the quality. Repairs are things that are typically routine. Inspections, cleaning, testing, replacement of worn out parts, appliances, whatever it might be, with comparable parts. And getting into a little more minutia, I forgot to remove this from my slide. So it's also routine if it's serviced 2+ times in a 10-year period. An improvement, for an example, now, so let me give you 2 examples of a repair versus a capitalized item. I live in Dallas. Kimberly is in the Dallas area as well. We get a lot of hailstorms. If a hailstorm hits my roof with 15-year shingles, damages my 15-year shingles, I replace them with 15-year shingles, it's a repair. They're not any better, it's just I'm replacing one thing with something very similar that was destroyed. If I take my 15-year shingles and I upgrade to a 30-year shingle, and let's say I make it a class 4 shingle, then suddenly I have an improvement, and that's something that you capitalize. There are other tax planning things, but this is just a very simple way that may help kind of drive the point home. So anything that I should stop and clarify here, or are the points still going to be better here in a few minutes?
Well, I'm going to throw out my own thing. I think where
Okay.
note investors get a little confused in this area is on property taxes. Because very often when we buy a note, we have to pay off the delinquent property taxes. And I assume that means that's part of maintaining ownership. We don't lose it to a tax sale. Accurate?
Right, yeah.
Okay. So, but what about when you're in a scenario, your borrower's having some trouble, they're trying to pay and whatever, and you pay their property taxes for them, and then it's added to their UPD. So you're eventually going to get that back. So it's not really an expense. It's not really a holding cost. It's an advance. Where the heck would we put that?
Yeah. That's a great question. And depending on the facts and circumstances, one thing I would think about it possibly being would be a receivable or an advance. So if I pay something that's $500 and I expect that I'm going to get $500 back, you can make some arguments, but I think most people who do accounting are probably going to lean to, I've paid the $500 out now, and I know I'm going to get it back. So that's my receivable. I advance somebody some money, and then when I receive the money, I'm going to decrease that receivable by the amount I receive.
Okay.
So I would put it on the balance sheet, and it would keep it off the income statement. There may be some arguments that start getting more aggressive, where you could say, I've got this expense, and maybe because I've paid it, and I don't know that this guy's going to pay me back, but it's going to be something that will set up potential discussions that we'd have to have with the IRS if they don't agree.
Okay.
Because at that point, if I'm taking a $500 expense, when I get the money paid back, then I'm also picking up the income because I have no other receivable to offset it. So I can see different ways that it could be looked at, but I would say probably the most consistent approach would be that typically it's probably going to be receivable. And if you at some point just write it off, then it becomes an expense because I paid the $500 and Jim Bob over here can't pay me back. So now I can't collect it. I'm an expense now. That gets into other timing issues and other accounting concerns. Okay. But a lot of that's just timing and things that it's always good to be talking to your accountant, your bookkeeper, your tax guy, whoever it is. What advantages do we think we can get? Because everybody's situation is going to be slightly different. and how aggressive or conservative you want to be that's one of those great conversations to have, especially early, because if it's something that you're doing today, we got 6 months to kind of figure out the best way to handle it. If we're talking about this that happened a year and a half ago, we're already out of 2018. It's a little harder to change how things really worked.
Gotcha.
That's more of what I call postmortem planning. my options are limited.
All right.
And then just to kind of I had to throw in something that's a little more fun after going through some bookkeeping, but as an accountant, I think I like some of these types of things, like this guy who's proud of, I don't want to brag, but I've got a loophole named after me. We want to help people find ways to keep their money in their own pocket and redeploy it and continue to use it to the best of their abilities. Loopholes, I really don't want to call it a loophole, but if we can find something that helps somebody gain a tax advantage that's legal, that's exactly where we want to play. We want to stay within the bounds of the law, but we want to take as much advantage as we can. There's 2 levels of taxes. There's the tax for the informed, and there's the tax for the uninformed. So with that, if there are some questions that I can help out with, or things that...
I got a couple for you. All right, let's see.
Okay.
Yeah, we went that one. Okay. So back to the unrealized gain conversation. Marco asked, when a non-performing borrower begins making payments, wouldn't you be realizing your gains in the installments that they make?
That's one possibility, and that also goes back to your methods of presentation. So from a tax standpoint, well, typically an installment gain is going to be something where you have sold it off to somebody else, and the amount of cash that you're getting off the total sales price comes in. So if I had, let's make the math simple. Let's take that non-performing note that we bought for $50,000. At one point, it's up to $70,000. And let's say a couple years later, we sell it for $100,000, and we sell it to somebody for $100,000, but we only get $10,000 right now. I'm going to recognize $10,000 out of $100,000. I'm going to recognize 10% of my profit. But if somebody is just paying off their note, then I still have my basis, but am I getting repaid some principal, or am I getting paid just back some of the interest? What all those factors and circumstances are kind of help determine what that really is. So it may be interest income, it may be repayment of principal on the note, and so there's not a real quick and simple answer.
Yeah.
But depending on what you're getting and when you're getting it, that will help you determine where it goes.
Well, I think one of the it depends situations. I think it would be how you got them to reperform. If they were, say, behind 6 months payments and you just threw that in as a balloon payment, deferred it till the end, and kept everything the same, and you're still getting the same payments that you bought before. But if you did a whole loan modification and now their UPB went from 70,000 to 100,000 and they're making payments on that 100,000, then you would be getting a little gain with each payment, right? Sort of.
A lot of technical information right there, and I may need to break that one down with you offline, because
all right,
since I'm being recorded, I'm not sure I won't be quoted on this one live.
Okay, you and I'll break it down, and then I'll follow up with Marco.
Okay.
All right, then Lynn asked, what about, back to the NPNs, apparently these non-performing notes confuse people. What about when we foreclose? How does the value of the asset change? You purchased a note, but now you own a house. So,
okay.
I don't know.
So that again goes back to your presentation. But let's go back to, from a tax standpoint, it really doesn't change the value of the note. If I paid $50,000, and let's say I got some recording fees and some other things, maybe I had to have it retitled after I've repossessed it, all those costs that I put into it, just shift from the note into my real estate that's owned. So if I had a $50,000 note and maybe my holding costs have brought me up to $60,000, my tax basis in that house is the $50,000 plus my $10,000 of holding costs. Now I've just taken the note off the balance sheet and I moved it into real estate that's owned. So your basis really doesn't change. To keep it very simple, I would say that it's the money that goes into there is what your tax basis is. What's it worth? That's where you start getting into all those unrealized gains and who am I presenting it to and what do I really want to track and do I want to have that on my books? Do I want to track it separately? Do I want to have two sets of books? That's where those pieces come in together.
Okay. What if it was one of those strange scenarios, strange in quotes?
I haven't come across any of those. I don't know what you're talking about.
Exactly. Everything's very cut and dry. Let's say that
it's all black and white.
It was $100,000 principal balance and we paid $50,000 for it. Let's say we expected the house to be worth $125,000. What if we go ahead and foreclose and we get the house back and it's worth a lot more than we expected or worth a lot less? Would that matter at all until we actually sold the house?
From a tax perspective, no. Okay. From a financial perspective, yeah, it would matter. But that's where you kind of have that secondary, either an unrealized gain or loss or something else that you're tracking that says, yeah, I paid $50,000, but look, I took my $50,000 and turned it into $125,000 or $200,000.
Okay.
So you'd have a $50,000 basis, but let's say it's worth $200,000. You've got an unrealized gain of an extra $150,000 that maybe in the picture I'm painting, I've got a $50,000 basis, but I've also got that unrealized gain of $150,000 that brings up my fair market value to $200,000. So one of the things that makes accounting difficult sometimes is accounting's reporting history. But if you want to know where you currently stand, sometimes you have to have a way to track the difference between history and fair market value. And so how you present that, how it makes it easy for you and everybody else who needs the information, everybody's going to have a different preference on how they want to make that look.
Okay. All right, I have another scenario for you. All right.
Okay.
Say the note that I'm foreclosing on has a unpaid principal balance of $200,000, but this house is not worth that much, and it's in an area I just don't want to own this house. So say I price it so I make 10%, 15% or whatever, and I set the price for 60 and it sells at 60. Does the IRS care that I was willing to just waive that other $140,000 and take my money and go home?
So the IRS is going to care. How much did we pay for the note?
Let's say it was the same one. We paid $50,000 for it.
Okay. So at that point, the IRS says you had the opportunity to get $200,000, but you got $60,000 for it.
Uh-huh.
We're only going to tax you on the difference between the $50,000 you paid for it and the $60,000 that you got for it. So from an unrealized standpoint, you may have lost $140,000. From a tax standpoint, I took $50,000, I turned it into $60,000, I made $10,000.
Okay.
So from those two standpoints, you've got differing answers. In one standpoint, I have a $10,000 gain. In another standpoint, but from a fair market standpoint, maybe it's worth $200,000, but I've got a $140,000 loss off of what I thought was worth $200,000.
Well, not necessarily, because it was the unpaid principal balance that was worth $200,000. The house was a piece of crap. So it was completely underwater. You're never going to collect that money. That's okay, right? Yeah,
that's okay. We were trying to get it from $50,000 to $200,000. It was never going to get there.
Mm-hmm.
That's just kind of this gap that we just weren't able to capture, and we're not going to get taxed on something that is kind of phantom.
Okay. All right, because the alternative in that scenario would be for me to file for a $140,000 loss, and they're certainly not going to want to do that. I mean, let me get away with that. So they should be happy.
Yeah, that's not a position I'd really want to sign on.
Okay. All right, let's see. I'm trying to ask these in a reasonable order. Okay, so back when we were talking about capitalizing some of the expenses and putting them in holding costs, were you including broker fees, wire transfer fees, and escrow fees that you have when you purchase a note? Would you capitalize those? And would you capitalize due diligence to buy the note?
So typically I would be looking at anything that, so let's go back to what holding costs are. Amounts paid to purchase, acquire, restore, improve property. So just from a high level, the acquisition, so can you read me that list?
Sure.
I probably can't go through and break down each one, but
okay.
Just
broker
the recording fees, for example.
Uh-huh.
Yeah, recording fees help you acquire the property.
Okay.
The title fees help you get the property. The commissions help you get the property. You said escrows?
Yep.
Was that one of them?
Uh-huh.
Escrows, I can actually paint a bunch of different scenarios, and that was going to get too much off in the weeds, because there are aspects that could be capital, there are aspects that could be expenses, and it all depends on the use and a bunch of other things. So if you're holding a note versus if you turn around and rent it, a lot of things kind of go into all those different scenarios.
Okay. What about your wire transfer?
Where I really don't want to get off into is, say, buying and holding a note, turning it into a flip, turning it into a rental. I mean, each one of those scenarios has a different answer.
Yes. And then, of course, if it's on a Tuesday in Louisiana, it's different than if it's a Friday in Florida.
Yeah. Well, in Louisiana, you're dealing with Napoleonic law. In Florida, you're working with, I don't even know, standard U.S. law.
All right, but what about
if I pat my head 3 times, rub my belly, then maybe I get one answer. And if I sneeze and cough a different way, I get a different one.
Oh, Lord. Okay, but what about wire transfer fees and due diligence costs?
So due diligence costs, now you and I've gone through, we've had this conversation a couple times.
Uh-huh.
The due diligence to acquire the property, or the due diligence to see how it's maintaining?
To acquire it.
Okay, to acquire, that goes back to amounts paid to acquire, produce, restore, or improve the property.
Okay.
Whereas we've also talked about amounts, once I've already acquired the property, and I'm just trying to figure out, is it still worth it? Should I turn around and sell it? There's an argument that could be made for capitalized. There's another argument that could be made for expense, and just trying to be consistent on that.
Okay. Now Marco wanted me to clarify. He's specifically talking about acquiring a note. Does that matter, acquiring a note versus acquiring real estate? Any of your answers change then?
Not really.
Okay.
Yeah, holding costs, capitalizing, it's acquiring, producing, restoring, or improving. I guess I probably should have made this more general, but property is pretty general. Property can be real estate, property can be a note, property can be a car. It's just something that is an asset, or something that you're buying that gives you benefit.
Okay.
So we have to break down property. When we're thinking real estate, we tend to think a piece of land with a building on it, but property from an accounting standpoint is much broader than that.
Okay. All right. And this is the last question that we have in chat. Okay. If you are taking your personal funds and loaning them to your LLC, what's the best way to document that, probably from a legal perspective and from an accounting perspective? And does your answer change whether you're talking about a single member LLC or a multi-member LLC?
Yes, my answer changes, but to back up a little bit further, I'm not a lawyer. I didn't stay at a Holiday Inn Express last night. I don't ever want to claim to be a lawyer because I don't want to deal with the Texas State Bar. So the legal answer, I'm going to have to say, contact your lawyer, ask them what they think about for the legal aspects. From a tax aspect, yes, the answer changes. If it's a single member LLC, I'm going to give you one answer. If it's a partnership, I'm going to give you a different answer. If it's an S corp, there's potentially another answer. They're going to be different, but a disregarded single member LLC, if you're loaning your money to it, from a tax standpoint, I really don't care how you record it. just knowing that that's more going to only cross legal lines. If you are loaning money to a partnership from a tax, and also if I'm a partner in it, I'd want to know that money was loaned in there, and that from a fiduciary standpoint, whoever is in charge of the partnership is taking care of it. So I'd want to know that it's in there, it's being recorded, and just kind of knowing the pecking order so that I know what's owed and who owes who. And so at that point, I'm probably talking to my lawyer. I'm also probably talking to my accountant, maybe my tax guy, and trying to figure out the best way to record it, because there are rules about how you record that, where you put it, charging yourself interest, those sorts of things. Kind of the same sort of scenario if it's an S corp or for something else. And there are different reasons you may use an S corp for one part of the transaction, partnership for another, a disregarded entity for another. And so knowing how each piece fits together is an important part of that equation. And I'm sure I've lost everybody by now that I think about what I've just said. But yeah. But yeah, if you're dealing with yourself, it's not as big of a deal as if you were dealing with a separate entity or other outside people.
Okay. Now
that's just a very general, broad statement.
Okay, not to go further down a rabbit hole you don't want to go down, but if in a scenario where you needed to use an S corp and a Dis corp and a Det corp to figure it out, would we get that advice from you, or would we get that advice from our attorney?
Yes. Both. So this is where I like to quarterback. I don't want to have every answer. I want to help out with making sure that the picture is set up. And at that point, there are legal things that need to be taken into consideration, and there are tax things that need to be taken into consideration. There may be financial things with a bank, so you may want to get a group and get everybody on the same page, because I may be thinking one thing from a tax standpoint. A lawyer may be thinking something from a legal standpoint. You may need something completely different. And so having all three people in the same room talking about the same things and getting on the same page, here are my options. Which one do I want to pick? And so you can say, if I paint scenario A, I get this answer. If I paint scenario B, I get this answer. And C gets me the third answer. Know it. That way you've got choices as far as, I'd want to do it for this reason, but maybe this might be better. This one might save me more money. This one protects me better. There are different reasons you may choose a lot of different answers.
Okay. All right, so that's it for questions in the group chat. I just have two quick ones for you. You talked about a bunch of different tools, QuickBooks, Xero, whatever. I think there's FreshBooks that you see online. Do any of those tools make it easier for you to work with our books, or do you not really care?
I think different people have different sets of books they like. I know there are firms that like QuickBooks because they have a relationship with them, they're used to them, so there's less time to get them up and running. QuickBooks is a tool that we use. I know that I've got clients that use Xero. I've got clients that use other accounting programs. The way I operate is I try and boil it down to something where it doesn't matter to me as much which set of books, as long as I have something to work with. But let me kind of take this as an opportunity to say, but the more important thing is, are they books that you're going to keep up with? So you can go out there and buy $1 million accounting system. If you don't like using it, or you don't understand it, and you're not going to keep up with it, it doesn't matter if you've got the $100 system or the $1 million system. Neither one's going to help if you're not using them. So sometimes some people just keep spreadsheets, and they come up with the most incredible spreadsheets I've ever seen. You give it to an accountant, they're probably going to want to use QuickBooks, or they're probably going to want to use some sort of financial statements. Give it to an engineer, they may enjoy spreadsheets because I know how a spreadsheet works, and I can sit there and manipulate it and come up with pivot tables and all sorts of things. And they're going to keep up with a spreadsheet a whole lot better than they're going to keep up with QuickBooks.
Gotcha.
But from my standpoint, I like something that I know I'm kind of almost putting it into a packaged box, so there's less room for error.
Okay.
So QuickBooks is one of those solutions. Is it my preference? Not really. I like it as well as I like some others. And in some scenarios, I like QuickBooks. In some scenarios, I really don't. But it depends on what I'm dealing with.
How about real estate and notes in general? QuickBooks works for that from your perspective?
So far,
Okay.
I have not seen anything that I would say I found looks like it works better, but that doesn't mean that there aren't packages out there that I'm not aware of.
Okay.
So if I come across something better, I'd be happy to let you know. But at this point in time, QuickBooks probably does it about as well as anything else.
Okay. Well, that's good to know. For someone who's trying to pick their first system, they might as well pick with the thing that's as good as you can come up with now. So, and then my last question, you mentioned one of the reasons why you want to keep your books together is so that you can remember what an expense was years later. Specifically with meals and entertainment, since they changed the tax laws on what you can deduct and what you can't, what is your recommendation for how to track that? Like I've often taken my receipts and just written down who I was talking to or what event it was at, but that doesn't necessarily prove that I had the intent to discuss business as opposed to just chatting, and that I could, am I overthinking it?
No, not really. I would love to say that there's a bright line test, and this is where I'd love to say that there's a black and white answer. But if you have the receipt, you wrote down who you talked to, and at least discuss, and I would also recommend adding on there, this is what we talked about.
Okay.
Then you're not the lowest hanging fruit. So when the IRS comes in, first off, if the IRS is asking me about meals and entertainment, I'm feeling like I'm pretty well scot-free. Like everything else is good because they're just looking for something. They want to go back and say, hey, I was able to get some money back. And they're usually going after meals and entertainment because at that point they can't find anything else, and they know that 99.5% of the people out there don't keep all the receipts and all the records and everything that if you read through all the IRS publications you're supposed to keep. So that's kind of the one area where, yeah, I can probably get some money back. So, but if you really want to just make sure you can hold on to every dime, yeah, write down where you were at, who you were talking to, and what you talked about. And they're going to have a really hard time even fighting that, because at that point, they've got to somehow recreate that wasn't what really happened.
Yeah, that's going to be
so
easy.
If you have, it's just like other things. The more that you have it documented, and the harder it is for them to argue a counterpoint, the more they're going to want to go pick the fight with somebody that's just a whole lot easier to get the money out of.
Okay. All right. That works for me. All righty. Well, no one else has posted any other questions, but we have gotten a lot of thank yous. So that's nice.
Well, again, thank you for inviting me. I definitely enjoyed this. Like I said before, when I started thinking about it, at first I didn't want to talk about bookkeeping, but as I thought about how this makes everybody's life easier, including mine, I thought, this is a great thing, because if I start talking to people about this in July, they've got 6 months to make their lives easier and everybody else's life easier.
Yep. Okay, everybody. I think we're done for the evening. What I will do is I will post Nate's contact information in Meetup and in the Facebook group, so you can find it if you want to chat with him directly. If for some reason you can't track that down, just email me and I'll send it to you specifically. Thank you, Nate. This was as awesome as I thought it was going to be.
I'm happy to hear that. And thanks for having me.
No problem. Have a good night, everybody.
Thank you.